Hey guys, what's going on? It's your boy Marco and trading under Merc FX. And what I'm going to go through is my swing trading strategy. So, whether you want to get funded, whether you want to trade on personal capital, whatever you want to do, you want an easy, simple to follow swing trading strategy, then this is the one for you. Disclaimer, so pause and read that. Intro. I mean, pretty much this one just sort of summarizes how um how practical swing trading is compared to trading in general, and um, I mean the methodical approach, the simple approach that can be applied in trading. All right, so these are the chapters. So they go a pretty basic thing. How I like to keep it simple. Number one, what is swing trading? So what even is it? So swing trading, a style that focuses on capturing price movements over the charts. So there are a lot of day traders out there. They trade on the 1 minute, 5 minute, 15 minute time frame. Me, I don't do that. I did at the start, but I like did it for 6 months. I didn't do much of it. I switched straight to the 4 hour, and I've been on the 4 hours for years now. Don't even really remember what year I started, but it's been something 3 or 4 years now. Anyway, so why swing trading? So less time intensive, the profit potential and reduce stress. So less time intensive. It's not like swing trading where you're glued to the charts for a few hours a day. This is like half an hour a day at max, really. Profit potential. So I mean, could you make more in day trading? Sure, like I'm sure you can. But look, it's just not for me. And the reward, like the risk to reward, pretty much not risk to reward, but the time output that I get from 30 minutes of the charts with my trading success compared to a few hours, like I'll take 30 minutes on the charts every day of the week. Reduce stress, that's another one. So very less, like there is less emotional strain than day trading. I mean, day trading's day in, day out, like a few hours here, you lost, you've won, you've lost, you won. While swing trading's like you traded maybe 15 trades for the month, check your results after that. Ideal traders for swing trading. So people that can commit 30 to 60 minutes. I mean, that's almost even just 30 minutes a day. Medium term outlook. So that's ties into pretty much the third point, which is patience and discipline. So one of the things when I first started off, I didn't realize that a lot of traders just sit on their hands and wait. I mean, like there's just patience. To me, I always just thought if I'm on the charts, I have to find a trade. Like, and then it took me a bit to realize that I could go days without trading, and that's a part of my plan. That's how I'm profitable in trading. All right, so number two, market structure. Okay, so there's pretty much three types of market structure. First one being an uptrend, so it's pretty obvious. I mean, you can see that in the bottom left, bottom right corner. First one, uptrend. So there's higher highs, higher lows. Um, yep, and then there's a downtrend, exact same thing, lower lows, lower highs, and sideways market, which is range bound. There's not really any new highs, not really any new lows. It's kind of confusing for traders. Me, I trade a lot on continuations and momentum, like trend trading. And when price is mega sideways, I tend to avoid it. All right, so breaks of structure in market structure. So break of structure is pretty much a certain major swing point getting broken. So you can see in that uptrend graphic, there are major swing points, and like where there was um, one high turned into a, and then there's a low, and then a new higher high which broke that previous high. Same with the downtrend, it broke that previous low. Then same in sideways. I mean, it can break that previous high and then it breaks that previous low, but then nothing really. There's no clear trend. There's no obvious way the market and price is going. Here's a chart example. I mean, like those red dots are the major swing points. Then you can see the breaker structure, how it broke through that recent. That's breaks the structure. structure and market structure. Go on to imbalance. So what is imbalance? So imbalance slash fair value gap, I say both. Where there's a big gap between buying and selling pressure in the market. So pretty much in this example here, you can see those yellow candles, which are the green candles, the bullish candles. You can see that there was so much pressure in the markets for the buyers that left a big gap in between the 2 wicks left and the right of it. So there are some are bigger than others, but um, like that's a strong sign of pressure in the market, whether that's selling pressure or buying pressure. Here's a chart example of the imbalance. So you can see price sort of ranged around a bit. Then all of a sudden there's these two huge yellow candles that have just pushed and broke the structure from the most recent high. So number 4, liquidity sweeps. This can be complicated. Some people overcomplicate this a lot. Pretty much a liquidity sweep is when liquidity is swept. So first off, you need to find the liquidity. So liquidity can be in equal resting highs, equal resting lows, in range bound markets, major highs, major lows. We can see here in the graphic below, so short and sharp liquidity sweep from a major swing. So that swing point, could you consider it a break of structure? Sure, you could, like the one with the dollar sign. That's what I use as liquidity sweeps. Could you use that as a break of structure? Yes, maybe you could, but it wasn't really a big break of structure, and price quickly grabbed the liquidity from the last major swing low and shot up. I mean, price needs resting orders to move. So price moves towards where there's liquidity. All right, so two main types of liquidity sweeps to focus on. Like one being the major swing point liquidity. So major swing point liquidity sweep occurs when large traders execute significant buy or sell orders at critical price levels, such as support and resistance. These sweeps cause rapid price movements, grabbing their resting liquidity and reversing price rapidly. So pretty much what I explained before, these major swing points, price did break through, but it shot up straight away. It just grabbed that previous resting liquidity. So consolidation liquidity. So it's when there's, as I mentioned, the range bound type of market, when there's just like no real movement, and then all of a sudden there's a big wick that grabs that resting liquidity and shoots back down. So here's a good example of that that consolidation liquidity sweep. So you can see it, like it's a bit range bound. There's no sort of clear direction before those big yellow candles towards the end there. But like it quickly grabbed that liquidity from that previous resting low and the consolidation points and shot straight up. That's a clear sign of a liquidity grab or a liquidity sweep. All right, we got number 5. So this is the actual strategy. So what you got to do is you got to put it all together. So pretty much the break of structure signals a shift in market sentiment. Imbalances highlight unfilled orders left behind by aggressive buying or selling. And then liquidity sweeps expose areas where large traders clear stop losses or key levels, which fuel significant price movement. So it's basically liquidity is the fuel for price. All right, here we've got an example. So we've got to look for our 3 things. One thing I will note is sometimes I don't use a liquidity sweep if the trend is very obvious, but I've seen great success using liquidity sweeps. So it's just one thing to note. That's like a 50-50 sort of thing, but my 100% requirements are break of structure and imbalance. We can see our break of structure. It's fine. We can point out these major highs, major lows. Break of structure. Imbalance. So now we've got imbalance. We can see here these little gaps of imbalance. I mean, you could even see You can look for yourself. Go on the markets, look for yourself where there's imbalance. Liquidity sweep. So finally, we have a liquidity sweep. So from a previous resting low, we've come and sucked that liquidity up. We've grabbed it, and price has shot up to the air. All right, so pretty much we place our order. So as price retraces towards our entry point, we place our order. So I place my order at the 0.75 Fibonacci retracement line. So from that swing high to swing low, this gives me a perfect 1 to 3 risk reward. So pretty much meaning you risk $100, so you might lose $100, but if it goes to that end of that green point, which is the 1, you'll make $300. Same with 1,000, you'll make 3,000. Same with 10,000, you'll make 30,000. That's as simple as it. All right, so trade active. So it retraced quickly and nicely. No real errors. One thing I will note is this is where the patience kicks in. So the retracement might be very slow. The trade might run off without triggering your entry. That's when you just sort of leave it. You just play the strategy, just play the game. That's it. Tapped in, awesome. It's a winner. Price pretty much shot straight up, and we got that win. So we got that 3. Here's a real life example of a trade I took sort of long ago. So we can see there's a big liquidity sweep, nice breaker structure, huge fair value gaps, and price tapped in and ran to take profit. So pretty much in summary, so risk management, I risk between 1 to 2%. Depends on leverage. If I get better leverage, I'll risk 2%. But at the moment, I risk 1%. You don't want to risk too much. You don't want to be risking 5%, something crazy. That's just too much. I mean, 10 losing trades and you're down 50%. Crazy. So checklist, as I said before, make sure there's a breaker structure, imbalance, and a liquidity sweep optional, but highly recommended. So final notes, you will lose. This strategy isn't a perfect 99% winning strategy. That doesn't really exist. If it does, tell me and I'll start trading it, but I haven't seen anything similar to that. So yeah, you will lose. Not all your trades will be winners. Even with a 30% win rate, you will still be profitable with a 3 risk reward. As we can see on the right here, you can see the risk rewards and win rate chart, table or graph or whatever. So your risk reward. So what I'm trading with is 1 to 3. So at 20%, it's not profitable. At 25%, it's break even. 30% and beyond, it's profitable. If you're trading with 1 to 5, even 20%, you'll be profitable. I mean, you just got to understand the maths here. That's the statistics. And then stick to your checklist. So that bottom right part. So chart setup. Does the trade follow your plan? No, don't take the trade. Does the trade follow your plan? Yes, take the trade. I mean, it's really as simple as that. You'd be amazed how many people can't grasp that concept. If it just doesn't if it doesn't match your plan, then just simply don't take it. Thank you very much for watching. If you got any questions, contact me through Instagram at MercFX. Shoot me a DM. I'll answer your DMs. More than happy to help. I've got this PDF in my link in my bio on my Instagram as well. I'll put it in the YouTube description. Thanks for watching, and I'll see you guys in the next one.